Hey everyone, welcome to the Christian and Tim show where we dive into the housing market here in the Vancouver area and across Canada to some extent as well. And you can now listen to us on Spotify, on Apple. Tim's a mortgage broker based here in the Vancouver Burnaby area and I'm a local realtor again for Vancouver and Burnaby area. And for today's topic, what we want to do is explore alternative investment options for you savers out there. You're working hard, you're saving money, you bought your principal residence, you have bought maybe filled up your TFSAs and some of your RSPs, and you're just thinking about diversifying. And so this talk might be for you. Now, I want you to know that should not be construed as investment advice. This is us having an open conversation, much like if we were driving in our cars talking to each other on the phone, we would be having a conversation like this. Both Tim and I are very interested in this topic, and so we'll be asking each other some questions. I'll probably be asking more questions, and Tim will be doing more answering on the other end. Now, just before we do that, I did want to let you know that while we're going to be talking about it again, neither of us runs a mortgage investment corporation, which are called MICs. Okay, so just so you're aware of that. Okay, let's jump into the topic I'm very curious about. Tim is as well, and that is talking about mortgage investment corporations. And well, I guess maybe we should briefly talk about what they are. Tim, do you want to just kind of give us a short primer on them?
Sure. Mortgage Investment Corporation, we'll probably call them MICs from now on, because that's kind of the jargon. But it's a mortgage investment corporation. It's a fund basically that can do that does private mortgages. I think I mentioned a few weeks back in Canada we have kind of three tiers of lending. There's the A side, then there's the alternative, and then there's private. So MICs are a private lender, so they take investors' money and they lend it out on as a mortgage, and get a return in the form of usually a lender fee and then the monthly interest. So as a general synopsis, I'll leave it there. You got anything
Okay.
to add? Anything I
Okay. Now,
missed?
I guess someone getting interested in this may think, well, how much money can I make as an investor doing this?
Hmm. Yeah, so it's thing to know about like mortgage investing or debt investing, if you will, is you're not going to get appreciation on your share price. So if you buy into a MIC, you're buying a share in this fund. The price of that share is not going to appreciate like the price of an Apple or Tesla stock, like we talked about earlier. Buy a Tesla stock for whatever it is now. You hope in the future the Tesla stock is worth more. So there's not that kind of unlimited upside potential that some stocks may have. However, the way you do make money on this is on an ongoing basis as a dividend. So these MICs pay a dividend on a monthly or quarterly or yearly basis, depending on the MIC. And so you can expect a return, in the neighborhood of probably 7 to 10%, depending on the MIC and depending on your risk appetite, if you will. So that's what you can expect, I would say.
Okay. Okay. And I mean, that is a very reasonable rate of return for I would think is very little risk if you can get 7 to 10% on your money. I remember talking to someone who was running one of these, and they did say that a lot of their investors were old people,
Yeah.
retirees. They just put their money in there, and just that was the way they would live off of it. Um,
Yeah, I think
what's
that's a
the
great use case. Sorry to interrupt, but I do think that's a great use case. If you have a significant amount of money and you want, a passive investment that's going to pay you monthly that you kind of live off of, that makes a ton of sense.
Yeah. What's the worst that can happen with these? What are the risks?
Um, well, the so what's the worst that could happen? I mean, you could lose money. um, And but I mean, that's kind of the risk with any of us. And the how you lose money is kind of the kind of more the question. But one of the more important things to understand is you don't have easy access to that capital. It's not like you hold it in, say your stock account where you can just sell the stock and exit the stock the same day. It's in a mortgage. So if the MIC has loaned out your money for whatever term, that money's kind of spoken for. So one of the things you want to look at when you're looking at a MIC is, how long is your money locked up for? And if you do need access to it, how much is that going to cost you? Because MICs should have liquidity so that if you do want to exit, they can facilitate that, but there will be a cost to it. So I think one of the big risks is not having immediate access to your money should you need it for something. And if you do need it, then it's going to come at a cost. And then another one, there's going to be fees associated with it. So you want to know how much, like any kind of investment fund, there's going to be an investment. So how much is the MIC taking off the top of what you're getting, so to speak? Is there a minimum amount you need to invest? And but then on the kind of the losing money side of things, if you have a non-performing loan, so if let's just say let's just look at one private loan. So a MIC is they're going to have a basket of mortgages, but let's just start with one and then we can see how it affects the basket. So if we have one mortgage, let's say I loan you, let's say you have $1 million property and I loan you 80% of that. And so I loan you $800,000. Say in a worst case scenario, or let's just say not a worst case, let's say a bad case scenario, the market turns, your property is now worth $800,000 and you no longer make your payments and we have to foreclose, or let's say it's worth 700,000 and we get 700,000 out of it. And so we lost $100,000. And so if I personally lent you that money, I'm out $100,000. So now we have to look at this as like a MIC, which has a fund, which has a pool. So they could have, they'll have hundreds or thousands of these mortgages. So, at any given time, they're probably going to have a certain percentage of non-performing loans, which they are losing money on, but that's kind of made up for by the ones that they are making money on. So that's kind of built into the return, if you will. So the risk becomes if a large percentage of them start losing money, then ultimately your share price, if you bought the share for $9, whatever, your share price could end up being worth less than that if you want to exit. So you could lose money through decreases in property value and non-performing loans.
So I think then, so the worst case scenario here is that you get a massive drop in property values. Property values come down 20, 30%. And if that's, in my view, if that's the worst case scenario, that is in a big city like Vancouver or Toronto, I would think that's a very small risk. There's a small probability of that happening. Now, it might be different if it's Fort McMurray, Alberta, which is a one-horse town, where 80% of the people are employed in the oil industry.
Right.
But if it's a big city, I would think I would have myself personally speaking anyway, I would have no concerns with the market ever dropping 30% in Vancouver. That would be, I just can't see that happening.
I mean, if it did, I think there'd be a lot of happy people in my generation that could afford to buy houses, but it might affect the mix a little bit. But I think also, like, the thing to keep in mind is even in that scenario, you're still protected. So if your $1 million home is now worth 700,000, if the private mortgage was for a 50% loan to value, that means you had a $500,000 loan, you should still be able to get all your capital back, right? So that I think is where the buffer comes in. And one of the important things to consider if you're looking at a MIC or doing a private investment is the LTV, because the higher the LTV, the higher the
LTV
risk.
Being
Loan to value. So if you have $1 million valued property and an $800,000 loan, that's an 80% loan to value, 80% LTV. $500,000 loan on that same property, same value, that would be a 50% LTV. So the lower your loan to value, the lower your risk. So if you have a portfolio with lower loan to values, theoretically, I could see it withstanding a drawdown. Yes.
Yeah. And I think just because if we look at sort of the last 40 years of Vancouver real estate history, and I'm talking about the greater Vancouver area, this is everything from UBC out to Maple Ridge. Yes, we get corrections, and we've had a correction through the coronavirus where it was maybe 7-8% on some detached in the area, a little bit more in the Fraser Valley. But we're basically back at all-time highs. And then prior to that, in 2018, 2019, you had the mortgage stress test. That was a big anvil on the market. But again, it didn't, we saw corrections of 5, 6, 7%, but nothing like these double digit numbers. Tim, let's go back to comparing this to other investments like stocks, like mutual funds, like index funds. I mean, the big one that even the Peter Lynch's and the Warren Buffetts will say is, get your principal residence. And in Canada, the big advantage of owning your own home is the government throws you a big tax break,
For now.
which is the principal residence capital gains exemption. So you buy it for 500,000, you live in it for 25 years, you sell it for 1.2, you get to keep all of it. You're not paying tax on that. And so that's one. And then you got your RSPs, TFSAs. But now when it comes, let's say it comes to, an index fund. So I've got most of my money in an index fund. And the one I have is just the plain vanilla boring one, the Vanguard S&P 500. Here in Canada on the TSX, it's the VFV. In the United States, I think it's called VOO. The reason I ended up putting most of my savings our savings into that is because I was doing some research on what Warren Buffett recommended to the average investor, and he was asked, what would you put if you weren't around, where would you put money for your wife? And he said, if I passed away, for my wife, everything would go into that specific index fund. I figure if it's good enough for Warren Buffett's wife, it's good enough for me. And so that's why I've done that. Now, the average return on the S&P 500, if you run it from 1967 to 2017, a 50-year time span, if I'm not mistaken, it's about 9.2%. And that's before inflation. So it probably runs around 7%. So that's why I'm thinking that Mick, here, something based here in British Columbia at 7 to 10%, like this is a no-brainer. If
Oh,
you
okay.
have,
I'm gonna stop you there. There's no
okay.
investments are a no-brainer. I just want to make sure we make that clear. There's no, and I want to make sure we're clear on the term. There's no investment is a no-brainer. Everyone needs to do their due diligence and evaluate the risk associated with any investment. But sorry, keep going. Yes, if you're comparing it to an index fund, sorry, I'll let you keep going.
Well, and I think it's even better than, in my view, mutual funds, which are charging the management expense ratio, right? That 2%, or 1.5% that they're charging. And there's lots of videos about this online. There's lots of stuff. People can do their own research on it. It draws a lot of money away from the investor. Anyway, so how can we, I mean, is there a way to mitigate the risks of investing in a MIC? Or is that a question you'd really ask? You would get a copy of the prospectus and find out how they do these loans.
Well, I mean, I think the first thing to understand is the differences between what an index fund is and what a MIC is, right? So an index fund, if you're saying it's returning 9% a year, so that's going to be in the appreciation and or dividends, but mostly it's going to be appreciation of the value of the index. So the index is basically a basket of stocks. And a stock is you're buying equity in a company. So when you're buying the index fund, you're buying equity in a bunch of different companies. If those companies become worth more, your percentage of them becomes worth more. So that is how, buying equities, it's called buying equities. That's how that works. And whether you're buying it in an index fund, or buying the stocks themselves. That's kind of how it works. Now, mutual funds, which I'm not necessarily a fan of, but those aren't typically only stocks. You might get some bonds in there. There might be some commodities in there. Those are going to be managed by an investment manager who's going to work the fund and trade or do whatever, and they take an expense fee. There's also investments like a GIC, right? That's another type of investment, guaranteed investment certificate. You can get those right now for about 5%. Those are from the banks. So, but the key difference that I want to make sure that we're explaining is with an index fund or buying equities, you're getting the appreciation from the equities. And, the average appreciation has been 9% or whatever, but there's been some significant drawdowns where you could have bought at the wrong time and sold at the wrong time and lost money, right? So that's how the risk kind of works for those. And in investing, there's nothing, the risk is kind of always in line with the reward. The reward that you're going to get is kind of tied to the risk. So because you're not going to get an 80% return investing in the S&P 500 most likely, because you're investing in a basket. It's kind of diversified. So you accept a more moderate return for a more moderate risk. And the same kind of goes, I think, when you want to look at investing in a MIC, you're going to get a decent return, but the risk that is kind of, it's not a 80% return risk, but it's it's the same risk as you're taking to get the 10% return. So if you invest, let's say you invest $10,000, that $10,000 doesn't have the potential to double in a year and be worth $20,000. Where if you invest in a stock, there is a potential that does happen. I mean, it could also, if you invest in a stock, it could also be worth $2, right? So that's kind of the key difference. You're investing that capital, and the idea is that you get all of that capital back once your lockup period, once your kind of term is done. You get all of that back, and in the meantime, you are paid a dividend, which is the interest that they're going to be charging on their mortgages. That's going to filter down to you, the investor. So you get that on a monthly basis. So they're lending out your money and giving you a percent return for that.
Tim, can the MIC invest outside its avenue? Can it go into another lane besides mortgages?
I don't believe so. I know that they can do commercial mortgages, but 50%, I think there's a tax rule that 50% of their investments must be in a combination of CDIC insured deposits and or residential.
Sorry, say that again.
CDIC insured deposits. That's a deposit insurance. So all banks that's okay. What insures. If you go to the bank and make a deposit, they have the CDIC insurance that ensures you're going to get your deposit back. So, right. 50% of their investments have to be in those CDIC insured deposits and or residentially secured mortgages. And I believe they can also do commercial mortgages, but I don't think they can do anything other than that. I mean, they're mortgage investment corporations. They might be able to, but not to my knowledge. And they have a tax exempt status as well. So
the way I've heard this explained to me is that through a MIC, again, a mortgage investment corp, they've got three baskets. They've got the low risk basket, the medium risk basket, and the high risk basket. And the low risk can be anywhere between 7, 10, then 10 and 12%, and then up to sort of 15% for the high risk. Is that kind of your understanding of it, or I don't know if you know that?
It depends on the MIC. And so some MICs will have multiple baskets that you can invest in. Some, all these funds kind of operate differently on their, where they'll lend. They all have their own kind of advantages and disadvantages, if you will. So some certainly do have those three buckets, and some they might only have one bucket. So it's, researching them kind of individually.
What kind of borrower is going to get, let's say, a 10 or even 15% mortgage? Like, because it sounds hefty.
It is hefty. And so, money has a cost, right? Everything has a cost, including money. And the way I like to think about interest rates is it's the cost of it's the cost of money, right? So you're paying a high cost for that money. So who is going to pay such a high cost to get that money? Well, and to be very clear, with private mortgages and this expensive money, it's almost always a short-term solution. This is never something that people are doing for 5 years, 10 years, something like that. This is usually a stopgap for a variety of circumstances. One could be a rush closing. You know, the mix or other private lenders can be very quick to get money and to move it around. They don't have as many regulations as the big banks and the other lenders, so they can help facilitate rush closings. You know, self-employed individuals who also require maybe a swift approval, or they haven't been in business for that long, but they're doing okay. So
Yeah.
those, go ahead.
No, go ahead.
You know, something we do see, unfortunately, individuals navigating a marital separation. So, you know, needing to do a spousal buyout, and sometimes those can get messy with, you know, lawsuits and stuff like that. And those are cases where traditional lenders might kind of shy away from that. And so you might need to go to a private lender to have them step in, kind of do the financing. Once everything gets sorted, you refinance it with a more traditional lender. You know, go ahead. Do you want to jump in there?
Yeah, I was going to ask, like, what percent? I mean, maybe somebody might be thinking this, but what percentage of these loans go sour? If,
I
but you might not know
I
that. I
don't
don't
know.
know.
I don't
Okay.
know. I mean,
Okay.
I would say, you know, a higher percentage of than the prime loans.
The
But
prime loans?
like a prime loan is going to a big bank. You know, the typical traditional mortgage, like more private mortgages are going to underperform than a, you know, an A level loan. So, but I don't have the numbers on that.
Right, right. The reason
Another,
I'm
go ahead. Yeah.
No, the reason I find it interesting is because you're kind of addressed the type of borrower this could be, is what was once myself.
Mm.
And the very first property we bought actually was through a MIC. And the reason was, as a real estate agent, you're considered a private contractor. You know, you're your own company in essence. And when you go to a big bank, they'll ask you for 2 years of income statements or 2 years worth of earnings. And I had just gotten started in real estate and things had gone well enough. And I thought, well, let's go ahead and let's pull the trigger on something sooner than later. And it was, what was it, 2016, 2017. And I could see there was, I mean, in the middle of January, cold, rainy nights, and I'd have 100 people showing up at an open house in Westwood Plateau. I thought this is crazy. Like the market is just gonna it's gonna go on a rocket ship, and I wanted to get in the market, and we did, and we used it as a stop gap, like you said, where it was just for 1 year, and then we rolled it in with one of the big banks.
Yep. Yeah, absolutely.
Yeah,
And that's very common. That was one of my notes here. Yeah, that's called business for self-employed people who are newer. It's exactly, you know, kind of what I touched on. And so that's a great use case. And look, it's worked out well for you. But you know, I think the key point there, like you said, is it was a stopgap, right? This is not and one of the things, if as a mortgage broker, if I'm doing a private mortgage, you know, one of the things I need to find out from the client and maybe help the client with, and then I also need to explain to the lender, is what's the exit strategy. And that's what we call it in the business, right? Okay, you're in this private mortgage. How are you getting out of it? What's your path to paying a lower rate? Because this is not, you know, paying such a high rate is not sustainable for a long period of time. It's definitely sustainable for a short period, but what's the plan? What's the pathway? So all of these scenarios are that I kind of chatted about, are when people there is a story, there's a plan, and for whatever reason they just don't meet all the restrictions of the big banks or what have you. So they need they're a bit riskier, for sure, which is why they're going to pay a higher premium, but they're going to have a plan and an exit strategy. So
sure.
another common one I wanted to just quickly mention is bridge loans. So that's if you're buying and selling places and the closings don't line up and you need money in the interim. Again, another really short use case.
Sure. Tim, what kind of background checks would a broker be doing on borrowers who are going the private route?
Basically, very, very similar to, and I mean, when we say background check, it's not like I'm not pulling police reports, but I do the same sort of due diligence that I would do for most other um, clients, and that's going to check their credit bureau for sure, read through it, and that also gets sent to the lender, so they're going to see that. Going to need to understand their income picture. How much money do they make? Where does it come from? See some documentation. Someone who's just getting started and they're self-employed might need to see bank statements and look at that and see it coming in, or see proof of contracts. Someone who's a contractor and they have some contracts gonna have to see something like that. Yeah, so going to need to know if and the property, if they're buying a property, going to need to see the approve or the purchase agreement, and going to need an appraisal, certainly. Those are so pretty
Yeah.
standard stuff. Yeah, so lots.
And the investors, like if we were invested in one, we would get I guess a quarterly update or a yearly update. And like we don't, how much do we know about who they're loaning the money to, or not much at all?
Yeah, you can get kind of a general overview of who the money is going to, but I don't think they'll give you, hey, we lent $10,000 to Tim Lyon because we thought he was a nice guy or whatever. They're not going to give you the kind of individual cases, but the key metric that you do want to keep an eye on, like I mentioned earlier, is that loan to value metric. And that's for the basket. That's, hey, and it loan to value and location. I think those are kind of two key things to look at in privates, because like you mentioned earlier, Vancouver, Toronto, big cities, there's the housing market is fairly stable. You go into some smaller places, there's more risk there, right? So if you have a lower loan to value, less risk. So those are, as a kind of first things I would look at.
Right, right. I had a mortgage broker once say to me, when someone is being foreclosed on, or this comes up, the first question he asks is, "Where is it?"
Yeah.
Not "What is it?"
Where is it? Yeah, absolutely.
Yeah, yeah. I mean, yeah. Uh, how would you go about starting one of these? And I presume this is going to be something that most mortgage, not most, but if it's going to get started, it's likely that a mortgage broker, someone like yourself, maybe even would look at this down the line in your career if you wanted to keep growing and try something different. That this would be like, how would it look?
How to start one, I have no idea. It's a corporation, so you'd have to, form a corporation. You have to be audited. So there's a bunch of regulatory hurdles to go through. So I'm not familiar with how to do that.
Right, right. And if someone were looking to maybe consider this as an investment, where would they find? Do you know where they would go to find out more about them?
To find out more about mix in general as for
Yeah.
investment purposes. Yeah,
And I asked that
yeah,
because I just generally don't see much about them online. And
yeah. I mean, if you Google mortgage investment corporation, you will find a bunch. But I also think it's, since there's not a lot about it, it's a non-traditional investment strategy. So you want to make sure you're talking to someone who can help you understand it. So, I'd suggest talking to a mortgage broker. They can probably point you in the direction of a few kind of more trustworthy mix, give you some ideas of where to look, things to think about. I have a list from a guy who started a MIC of 20 different points to consider when you're investing in a MIC. So that's something that I would want to make sure that anybody who is going to invest read and then asked all those questions of the MIC they were investing in.
folks, that's a good reason to send Tim an email, and you will see his email in the show notes below. I think we're coming up on time, so I want to say thanks to everyone for joining us on Spotify, Apple, and if you're watching on YouTube, and we'll see you next time. Tim, thanks for being here.
Yeah, thanks everybody. And yeah, talk to you next week.